in terms of the markets, this notion of average inflation targeting seems to be sort of a blank check for the markets to go out on the limb and go to some of the more riskier assets. At what point should the Fed, or should the Fed at all, be concerned about the ramifications of its policies in terms of asset bubbles?
Oh, yes. There is a rip-roaring inflation in, among other things, in the cost of income, cost of a dollar of income. When the Treasury, long-term Treasury, or the 10-year Treasury yield at 5%, if you were fortunate enough to have $1 million in savings, you could take $50,000 a year in income from that pool of savings. At 70 basis points or thereabouts, you need upwards of 6.7 million or so to generate the same 50,000. And if the 10-year yield were to fall to 50 basis points, you would need $10 million. So there is a huge, there is an intended consequence, and then there are the unintended consequences, very low rates and nonstop intervention. And what we are looking at is a great levitation in assets, a great levitation in speculative sentiment, and a widespread, I would say, misallocation of capital. And we are building up much more debt. It was, I think, March of 2019, President Kaplan of Dallas Fed said, we should not raise rates because corporate debt is encumbering the economy. Well, in the past 6, 8, 10 weeks, we have had record issuance of junk bonds and investment-grade corporates. So more leverage, more intervention, lower rates, more certainty about the absence of checkout counterinflation. So this is, I think, Chairman Powell's challenge today is not to sound like the president of the National Institutes of Health getting behind a plan to reinstitute the measles. That's what he's up against, because it certainly sounds that way to me, with the Fed getting behind the scheme to reinflate our economy.
Sarah, what do you think of what Jim said, and does Jerome Powell face that challenge?
So Jim's made some great points, and I would add that this is really the culmination of a 2-year effort that the Federal Reserve has undertaken to reevaluate its monetary policy frameworks, particularly in light of the fact that inflation has been so low. Even pre-pandemic, it has been extraordinarily challenging for the Fed to be reaching this agreed upon consensus of a 2% target. And with that backdrop, we've got to, and the Fed in particular has to grapple with the fact that something is going on in the economy in terms of usual economic relationships that haven't held and really haven't been holding since the time of the Great Recession. And so that really is an important context to keep in mind, which is essentially the 2% number is really something that hasn't been able to be hit or even get close to being hit. And the Fed really needs something else. It needs something that is much more realistic. You'll remember that, price stability and the inflation mandate is one of the 2 important mandates that the Fed has, and the Fed has been missing it consistently. And so this is part of, this new framework, which will, I think, only begin to get introduced at Chairman Powell's talk today, is an attempt really to grapple with the fact that 2% number has not been working, and thinking about how the Fed can be meeting that part of its mandate. Now, there's an additional set of reactions that this change could have, and it could have the effect of being slightly more accommodative or signaling more accommodation. Mm-hmm. But remember, this is an effort that has been underway even pre-pandemic in terms of trying to understand why the Fed has been losing out on this part of the mandate.